Hello and welcome to Digital Accounting Education, a channel that strives to make accounting and EMS easy for you to understand. Don't forget to comment down below and like the video as well as subscribe to the channel. Don't forget to also share these videos with your peers. So today we are going to talk about general ledger accounts. Now I know that this topic gives a lot of learners a challenge. So today I'm going to give you a principle that will help you understand it and never to forget how the tier accounts actually work. You will get to see today that tier accounts are actually very simple. So before we get into it, let us try to understand what a T account actually looks like. So a T account generally just looks like a T, like this. Okay, so it has both sides. It has the right hand side as well as the left hand side. So I know that it has other columns inside the T account on each side. However, that is not what I'm going to focus on right now. So on your left hand side, we call this left hand side the debit side. Okay, however, we just write it as a DR. So DR stands for debit side. And then on your right hand side, we have a credit side, which we usually just write it as a CR. Okay, so now with T account, what makes it very difficult and challenging is that in accounting we have so many accounts. Okay, we have so many asset accounts, a lot of expenses, a lot of income accounts, liabilities, owner's equity, you name it. Okay, so the only challenging part is that you don't actually know on which side does that specific account you will be dealing with at that time. You don't know which side it increases on and which side it decreases on, because they don't all increase on the same side and decrease on the same side as well. So the trick is to know the principle that I'm about to show you now, and please don't ever forget this principle. Okay, so the principle is called the dead click. Okay, this is actually an abbreviation of which each letter stands for something, which we are about to unpack right now. So the dead actually stands for debit all. Okay, so it says you must debit all of these accounts I'm going to mention just now. So you're going to debit all expenses, you're going to debit all your assets and drawings. So what do I mean actually when I say you must debit all expenses, all assets, and all drawings? What I'm basically saying to you is that all these three accounts, they increase on the debit side. Okay, so we move on to the Clic. The Clic stands for credit all, liabilities, incomes, and capital. So same thing. What do I actually mean? I mean that all these three accounts, they increase on the credit side. All right. So now let me show you how these T accounts will look. So the T accounts that fall under the dead abbreviation will actually look like this. So we said they all increase on the debit side, right? So it means all of them will look something like this. So whether it's an expense account, it is going to increase on the debit side and decrease on the credit side. If it's an asset account, it is going to increase on the debit side and decrease on the credit side, as well as your drawings. Then moving on to our Clic abbreviation, the T accounts for the Clic accounts will look like this. We said they increase on which side? Credit side. Okay, so the plus will be on the credit side while the minus will be on the debit side. So if you have a liability account, the account will look like this. If you have an income account, the income account will increase on the credit side and decrease on the debit side, so as the capital account. I hope you understand. So I'm just going to give you an example. So now let's say that a transaction is given to you and they say that on day 25, bought goods on credit from AB Traders 4,800. And I explained that whenever you read a transaction, make sure that you understand exactly what they are telling you. You must analyze it. So let us look at our transaction. So first of all, they said we bought goods, right? So goods obviously means trading stock. We bought trading stock and we bought it on credit. Okay, so this already tells you something. We bought goods, however, we didn't pay for them. We bought them on credit. So two accounts which will be affected will be goods. Goods are trading stock. So now you're going to open your trading stock account. Remember that if we are buying on credit, we are buying from our creditors. The business that we are buying from on credit, they are our creditors, meaning that creditors control will be affected as well. So you open a creditors control T account as well. So now the trick is for you to know what we classify these two accounts as. Okay, so now trading stock, we know trading stock is an asset already. Okay, so trading stock is an asset, and our creditors control is a liability. It is debts of the business, so it is a liability account. Okay, so now let us go to our debt Clic so we can know which side each account increases and which side it will decrease on. So looking at the debt Clic, the A, which is assets, our trading stock, is in the abbreviation debt. And we said that our accounts that fall under debt, they will look like this. Moving on to the creditors control account, we said that it is a liability, and liabilities fall under the abbreviation Clic. And we said our Clic T accounts look like this. Okay, so let us go to our accounts. So trading stock, we said the debt accounts increase on the debit side and they decrease on the credit side. While our creditors control, which is liabilities, in the Clic abbreviation, they increase on the credit side and decrease on the debit side. So how are you going to now record this transaction? So I'm not going to enter the date. I'm just going to show the amount and the detail. So you go into your trading stock account and you ask yourself, with trading stock, what is actually happening? What is happening is that we bought trading stock, which means now the value of the stock that we have in the business will now increase. So the trading stock account increases on the debit side, which means your amount will be shown on the debit side of the trading stock to show that trading stock is actually increasing. So the detail will be creditors control because it is the contra account. Or you can just ask yourself, how did I buy this trading stock? We bought the trading stock on credit, meaning your detail will be creditors control. And then moving on to creditors control account, you ask yourself the same question. What happened to my creditors control account? Is it increasing or is it decreasing? So now if we buy on credit, it means we are increasing our debt. Ultimately, our liabilities are increasing, right? So now you go on the side that our creditors control is increasing on and you enter the amount. So the amount, you are saying that we have increased our liabilities by 4,800. Okay, and what did we buy from these creditors? We bought trading stock. This is basically how you do it. Remember, this is the detail, this is the amount. You have to also record the date. Just don't forget to do that. I just prefer to show it like this because these are the most important parts. Just don't forget the principle, the debt Clic. Okay, so the debt, just know debt stands for debit all your expenses, your assets and drawings, meaning these three main accounts, they increase on the debit side. Obviously, if they increase on the debit side, it means they will decrease on the other one. And then the Clic means that all these three accounts increase on the credit side. Okay, just don't forget it. So the only thing you have to know is your expenses accounts. For example, if you have to open a rent expense, you need to know that it falls under expenses. You need to know all your asset accounts so that you can be able to identify that this is an asset account. For example, stock. Now we know that stock is an asset account. Petty cash, that's an asset account. Equipment, that's an asset account. And then drawings is an account on its own. And then your liabilities, it's accounts like loan, creditors control, and the others. With incomes, we have rent income, we have commission income, current income, we have sales, and then capital is also its own account. Just make sure you know the sub accounts that fall under these four, which are expenses, assets, liabilities, and incomes. I hope this has made T accounts extremely easy for you to understand. If you have any questions, please drop them down below and I will answer as soon as possible. Please just text the number that is down below in the description box and let us see the way forward. I hope you enjoyed. Bye.